many tools, too much stress, and way too many bills.
Odoo replaces it all. One connected platform for every part of your business, so you can work faster, smarter, and for less. Odoo, the only software you'll ever need. Try it free today at odoo.com. That's ODOO.com.
Hi there, everyone, and welcome back to Real Estate, Real and Unscripted with Nicole Miller. I'm excited that you are joining us this week, and I hope that you're going to get some awesome nuggets, as is the point of my show, is to make sure that I am touching on everything that touches the real estate ecosystem, every subject. So I'm bringing on experts in all different fields. We're doing a lot of loans right now, specifically, and so it's not just about the basics, right? I want to really dig in so that we can really get all that information out there. So today, we are going to be focusing on condo financing. Oh, condos. As I got myself into this business as a realtor, I was dubbed the condo queen. I sold dozens of condos every year, and they are fun. Yeah, and they've gotten even more fun, and they're going to get even more fun. So I'm excited to bring on with me David Sheir, who is the South Florida area manager with CMG Home Loans, and he brings a wealth of information and knowledge to our show today. And I am looking forward to it because we're going to focus on the condo financing side of it and go deep into everything as much as we can about the considerations when condos are factored into financing. So thank you so much for joining, David. I appreciate you being on with us today and helping get some information out there to the public. Thank you so much, and tell us a little about yourself. How did you get into this field? How did you drop into lending? And then, as I had shared, I'm always very big on what makes you different. How are you shaking up your space? What are you bringing to the table that really kind of elevates it?
Well, first of all, good afternoon. Thank you, Nicole, for having me on your show. I really appreciate it. So I got into mortgages sort of by accident. You know, nobody really shows up at career fairs on college campuses saying, hey, would you like to be a mortgage loan officer? I went into accounting. I got a master's degree in accounting. I took my CPA exam. I passed that. I worked for a big CPA firm, worked the controllership and the CFO route in public companies. And then I got hired by a developer in South Florida in 1998 to be their chief financial officer. And while I was there, we decided to start a captive builder mortgage company. So I started that and ran both their CFO work and I ran their mortgage company. We eventually sold both of them to a public builder, and I had to make a decision. And it was 2008, mind you, right? So the decision was either take the easy way out, go back to CFO work, have a nice safe salary, or do the crazy thing, go back into the mortgage business full time in 2008 with commission only, no certain future, and of course that's the path I chose.
Of course.
I chose in 2008 because that's what we do. We love the thrill of the industry. We love helping people directly. I felt like it had more impact. It was more fulfilling to me to help consumers get into their dream homes as opposed to just running spreadsheets and tax returns. So that's how I got in. Now, what makes me different is exactly that. My background, it's very rare you'll find a loan officer who, to be a loan officer, not taking anything away from the industry, you need a GED, 20 hours of CE
20
online,
hours.
and pass the course.
Yeah,
That's it. So, I mean, even to be a real estate agent is tougher to be a mortgage loan officer. And they're both very important jobs, but certainly dealing with somebody's most important asset in their whole lifetime, 20 hours of CE, a GED, and a pass the test. Again, not taking anything away from the existing loan officers. I've got a master's degree in accounting and tax. I was a CPA. I held that license up until 2017 when I really no longer needed it. And I bring a wealth of experience as a CFO of a developer. We built up to 1,000 homes a year. We're a production home builder. I ran my own mortgage company. I understand tax returns. So my clientele tends to be self-employed people with high complex tax returns, high net worth individuals. I do a lot of non-QM lending. I do a ton of condo lending, which we'll get into. And I'm kind of known as the rescue king. A lot of people come to me after they've been died by other lenders or other banks, and with that experience and my creativity, I help them get closed.
I think the experience that you said about having the accounting background is huge. Because when I get offers on my listings, I have a list of questions that I follow up with the lenders on. And that list of questions, I'm also LO trained, I'm getting my license at 20 hours, right? I did that years ago. I teach classes on how to look at your listing offers through the lens of, making sure that the only reason the deal falls apart is if someone loses their job or drops dead or decides not to want to close. There's really no reason that something comes out of underwriting and they're like, oh, the debt to income ratio is too high because blah, blah. And it's like, no, it's not. This is a house that has this much for insurance, right? And did you ask the loan officer what they used when they did that pre-qualification, right? So there's a lot of things that I pride myself on making sure that we check. Now the condo space has just been completely I used to be able to really know everything and be like, yep, I'm 99.9% sure. Now it's all over, hitting you from right. I mean, it's just been nuts. It's the one thing, now something else, and then that now too. So things have obviously changed, and we'll talk through that. But when you bring that to the table of having that background from the financial lens, working with someone like you is super important for the end user consumer, because if you're going to get pre-approved and you are self-employed, and that's one of the questions I ask when I get these pre-approval letters, are they W-2, are they self-employed? And then certain questions that come after that with respect to it, if they are self-employed, I get answers back from some of these loan officers. They didn't check. They didn't look, they didn't review everything. They didn't. And if you're going to certain bigger financial institutions, and I've said this before, they don't invest as much into you. Your pre-approval is a pre-qual. It's as good as toilet paper. It's not gone through underwriting. The guy who took it doesn't have a loan license. Usually they work under the banks, right? And they're not really digging into those things. So when they ask you, Joe, how much do you make? And you're like, 400,000. And then yeah, no, you had, your K1 brought forth a ton of negative, right? No, he made 400, but on his tax return, he's at 80 grand, right? So those are not the same. So when you work with someone who is looking at the full picture and can really give you that approval with a background lens of an accountant, it's huge. So I think that definitely is, I could see how you've become successful in that realm. And that's a big part of why. So I put it out there to the public to really make sure that when you're getting that pre-approval, that they're looking at it and they have looked at your tax returns. You're working with someone like David who can actually really give you that information, because the worst thing you can do is go out there, start shopping, and then discover that things are a problem, especially when you're self-employed, right? There's a lot of things that come up. And
you're making some really important points. The devil's in the details. I know it sounds cliche-ish, but to have a pre-approval letter means, unlike a pre-qualification which is just taking the information verbally, issuing a letter, it's not really worth the paper it's written on. When we do a pre-approval letter, we look at everything from tax returns, bank statements, employment records, credit reports, bank statements, brokerage statements. We look at the property to see whether or not the property is going to at least pass from, and again, we'll get into the condominium, whether it's going to pass from a condominium standpoint. We're extremely thorough up front before we issue the pre-approval letter, because at that point we know we're pretty much going to get the approval, and there's going to be no surprises at the end. So we front load all of the documentation up front, and I know that you get that. We had a lot of discussions about that.
I know it's super important. So we're going to be talking through condo financing, and so I'm going to start by saying, what's the difference? Why is this a separate entity in all of itself? Why am I talking about condo financing? Whereas, you get a loan, you get a conventional loan. People are like, oh, I'm pre-approved for a conventional loan, and I'm going to go and shop for a $400,000 condo. Well, David didn't know you were looking at condos. There's many things that are going to affect that 400,000 anyway. But, what are some of the things that, what are some of the things that are different when we are dealing with condo? And I know that's a super broad question, so we can kind of parse out from there, but whatever kind of comes to mind off the bat and from a lender standpoint and underwriting standpoint, things that are looked at.
Sure. So Fannie Mae and Freddie Mac actually goes back to 2008 because of the real estate crisis back then, when they really started looking at condominiums. in more detail. And that's when they had a pretty thorough review process, even really before that, but certainly in 2008, they found that a lot of the defaults happened with second home and investment properties on condominiums. So they started to tighten the screws on condominium collateral review, if you will, property review on condominiums in 2008. And then you had the unfortunate event in Champlain Towers in Surfside, and then it was really opening up the floodgates of litigation and law changes and regulations, both with the state of Florida, and then finally, as we've seen recently this past month, with Fannie Mae and Freddie Mac. And what that means is, so you've got two separate sets of regulations. You've got the state laws, and then you've got the financing laws, and they intersect at certain points, and at some points they don't. So, I don't know if you want me to go into both or just Fannie Mae, but they are intertwined. With respect to the Florida laws, they started this a couple of years ago. They have made some amendments to it. It finally issued their final ruling on it with clarifications last year in June. But basically, it boils down to this. There's two governing laws. One deals with the financial reserves of the condominium, and the second one deals with the milestone inspections. Think of that as the structure of the building, right? So the first one, the financial reserves, says that by the end of last year, there is certain exceptions that gives them till the end of this year if they have a milestone inspection due this year. But essentially, most condominiums by now, because of December 31st, 2025 deadline, should have what they call a structural integrity reserve report, okay, a SIRS, SSIRS, okay? Basically, what it does is you're supposed to hire CPAs and accountants and architects and engineers and put together a basic reserve study that goes at least 10 years out that says, based upon all of these capital outlays that you're going to have and improvements on things like the roofs, the elevators, the parking, the lobby, what you should expect to have to fund that reserve by year over the next 10 years, okay? And a lot of times they'll give a good, better, best, right? They'll give 3 ranges and then they'll recommend one. So that's the reserve part of it. The milestone part of it says that the reserve part is not based on a date of the condominium being created. It's based upon all condominiums in the state of Florida by last year. The second part, the inspection report or milestone reports, are due based on age of condominium, and it's 25 years after the creation of the condominium. If it's within, I believe it's 3 miles of the coast, which pretty much most of South Florida is, and 30 years if it's outside of 3 miles. And they then further clarified that the 3 stories or more means 3 habitable stories, right? So if you've got 2 stories with a garage underneath, you're not subject to the milestone inspection, right? So it's 3 habitable stories, okay, or more. Then you have to have every 25 years, or again, every 30 years, this milestone inspection. And that's where you bring
starting at 30 years and starting at 25, and then after that is every 10 years after that. Just to clarify, yeah. Sorry, just we talk real quick, but yeah. Now I know you know that. I just wanted to clarify. It starts at 25, and then it's every 10 years after that, guys.
Correct. And that's where they comprehensively go through with obviously inspectors and engineers and architects, and they look at everything and they say, okay, this is what has to get done, and this is what's deficient, this is what's okay, this is what's critically deficient. And if there's critical repairs, that triggers a whole new set of rules. And you have to go into sort of a phase 2 process. Yeah. And then that is issued as a report, and that report, and part of the lending process, and this is where it can really affect lending, we're always going to ask for the SIRS report, right? Because by now you should have it. So every lender is going to ask for a SIRS report. If you have on the questionnaire, they will ask if you've had a milestone inspection report, and or if you've had any regulatory body, meaning the county, the city, or any municipality issue you some sort of citation for an uninhabitable or unsafe or some sort of critical structural deficiency. If you get that on the milestone inspection report, that presents a whole set of other challenges, because now you've got things like special assessments, and you've got the lenders going to determine whether or not that special assessment is financially feasible and not burdensome, so where it's going to affect the mortgage and the repayment of it, but most importantly, whether or not they're going to be in a safety and soundness unsafe environment. Okay, so those are, in a nutshell, at a very high level, the two components of the state rules. All right, and then you go ahead.
No, I was just saying, when you're buying a condo, think of it this way: it's shared risk among all these other people, right? So the lender is basically giving you a loan, but it's not just you. Your unit is subject to a lot of other things, right? So typically when you have condo loans, usually the rates are a little bit higher, right? So there's a higher level of risk because there's so many other factors into it. So, when you're buying a house, very different. Here, they're evaluating a project. You as a potential condo owner are now 1/50th of that of that structure, or 1/80th or 1/400th of that structure. All of the things that have to happen with that structure to keep, your unit 205 on the fifth stack on the second floor is not just you, right? So that's why a lot of this is so detailed, and why, I had sellers that were like, why are they so difficult? Why are they asking for this? I don't understand. She got a loan. I literally just dealt with this, and she got the loan. She's qualified. Why can't she just buy the condo? And I'm like, because she's not just buying the condo. She's buying you and your 450 other neighbors and the building and the structure and the liability that comes forth with everything else, right? So that's a big, reason why. And Florida always had a little bit of a different, right? When it was 25%, right? So there's different things as far as down payment requirements, and we'll talk through that. But Florida was handled very differently. So you'll have people from other states that will say, oh, it's 20% to avoid a full review. Well, we'll talk about that, right? So that's all changing too. But it was different in Florida. We always had this 25% or less is going to trigger a certain type of questionnaire, or 25% or more down is going to trigger a different kind of questionnaire. And Florida was always looked at very differently. And a lot of agents I feel like I've come in contact with too didn't know that, right? So, but yeah, go ahead on with that. I just wanted to kind of plug in something that I was thinking about.
Yeah, no, you made a great point. When you're buying a condominium, what I tell my clients that come to me is, look, when you're interested in buying a condominium, not only do we have to approve you, right, but we have to now approve the condominium. Whereas on a single family home or a PUD or a townhouse, as long as it appraises out for the most part, and there's not anything noted on the appraisal report in terms of repairs, that's all we do. But on a condominium, because they had the condo board and management company have a fiduciary responsibility, as you mentioned, to multiple unit owners, your neighbors and yourselves. You are now collectively in this project together. Mm-hmm. So it affects the entire the building. But getting back to the guidelines, in Fannie Mae then caught up finally with the state of Florida and all of the challenges we were having with respect to, okay, is it the budget going to be 10%? Is it going to be the SERS report? They also got into whether or not in Florida it was very hard to get master policies. And you saw that some of the master policies were going to 10% deductibles. Well, that didn't work for Fannie Mae and Freddie Mac. They were going with actual replacement cost on the roofs. Well, that didn't work for Fannie Mae and Freddie Mac. And they were doing everything they could at the the condo associations, understandably, to keep those premiums as low as possible.
To offset, right? To offset the higher reserve required, to offset the higher insurance that you don't want to make. That's a big part that really ended up kind of hurting a lot of these condos.
Yep, 100%. So here's the good news. Fannie Mae finally, in March of this year, came out with a lender letter, which is guidance for both Fannie Mae and Freddie Mac follows along. And I'll go over the good stuff first, right? Because there is some good stuff in there. For example, they will now allow replacement cost on roofs. Actual cash value on roofs. So the rest of the property has to be at replacement cost, meaning if, God forbid, something should happen to the building, that you are insured at the cost to replace that building. The roof itself now can be at actual cash value, which is essentially the depreciated value of the roof, okay? So that now follows along with all of the underwriting, the insurance guidelines in the state of Florida. Because if you remember, a couple of years ago, Governor DeSantis changed the Florida insurance law because people were claiming full entitlement to replacement cost on roofs that were like 20 years old, and it was killing the insurance premiums. So Fannie Mae came back finally, and Freddie Mac came back finally and said, look, We'll let you go where actual cash value on the roofs, the rest of it has to be replacement cost. That's a big help, all right? So that'll certainly help. Another good thing is there's this thing called PERS under Fannie Mae. It stands for Project Eligibility Review Service. And if you thought the full review was extensive, any new condominium, brand new in the state of Florida, and only the state of Florida, not the other 49 states, were required to go through this Project Eligibility Review Service. It was like the full review on steroids. I mean, it would cost thousands of dollars if you wanted to build a new condominium and you wanted it to be Fannie Mae or Freddie Mac eligible. You had to send over architectural plans, specifications, your engineering reports, your soil reports, your environmental reports, your declarations, your budget, everything in the world you could think of had to be submitted through a lender approved with Fannie or Freddie Direct, and it would cost $10,000 to get it done in a few months. So that was reversed, and you no longer have to go through that process in the state of Florida as a new construction. Okay. You're not required to go through PERS. You are now allowed to go through the single unit or condo project manager system, which is like every other resale condominium. So that's going to significantly speed up new construction approval for Fannie Mae and Freddie Mac and significantly reduce that cost. You would just go through the regular full review, okay, under the condo project manager. So that was a good thing. Mm-hmm. Other good thing is they exempted up to 10 unit condominiums. So if you're 10 units or less, you do not have to get a condominium approval at all from Fannie Mae or Freddie Mac. So that's a new thing.
Oh,
up to 10 units. Yeah. I'm trying to think of all the other good things here. As I go along, let me go over some of the changes that may affect us to the negative, right?
Yeah.
So as we all know, 10% of your annual assessments or dues, your regular, dues, condo dues, 10% of it had to have been separated and budgeted and put into a reserve bank account. That doesn't mean that your reserve bank account was 10% of it. That meant that every year, 10% of what you collected had to go into an account, right? So you collected $1 million, you got to put $100,000 away every year, okay? No matter how big that reserve account was. It is now going to 15%, effective in August. Effective in January of 2026. Okay.
Okay. So people out there who are listening to this, we have people that could be board members and, whatnot. So keep this in mind through that lens as well, because even before the 10% was really tough, I wanted to just really quickly interject. I've had budgets where they were at like 9.8 after even removing pass-throughs. And if they would have done the 10%, it would have been like $10 more a month for everyone, right? But then now they were in a position where they can't finance under 25% down. So a lot of these boards, I feel like they may, or even management companies need to know this to understand how they can best position their condo complex to be able to be as best marketed as possible, in light of what David's going to share with us next too.
Yeah, so that effective date is January 4th, 2027. So as of January 4th, 2027, which really means, they start to meet the board usually around September, October to start the budget for the next year. So come September, October, November, December of this year, the boards will have to plan for a minimum of 15% of their annual collected association fees. Why do I say minimum? Because remember that SERS report we talked about. So the state of Florida has a different calculation. They don't take a straight percentage. They take a very detailed line-by-line spreadsheet of what they expect over the next 10 years, and they give you 3 numbers, right? Good, better, best. Fannie Mae now requires the greater of 15% or that best number, the highest number. So if the reserve, and by the way, when they do this reserve study, you can literally have varying degrees of number based off of year 1 through year 10. Year 1 could be a lower number, year 2 could be a higher number, year 3 could be a lower number, okay? Right. It's actually when they expect it to hit. So what we'll do as a lender is we'll look at, okay, it's 2026, right? Or let's go to 2027. And you're now looking to apply for a mortgage on a condominium. We're going to get their SERS report. We're going to get their budgets. We're going to look at the SERS report for 2027. And if it says that you need to collect, I don't know, let's call it 10%, and Fannie Mae says 15%, the greater is going to be 15%. If the CERS says at the highest funded level, 20%, we're going to collect the 20%, or we're going to expect the 20%. So it's the greater of 15% according to Fannie Mae and Freddie Mac come next year, or whatever the highest number is in that CERS report for that year. And that's going to significantly affect.
Yeah, I was going to say, so what's going to happen if the condo complex is fully funded, not fully budgeted funded, right? Not like fully funded in the bank already funded, difference, right? What if they were budgeted properly according to this CERS, and because they hypothetically just did their roof 2 years ago and they did an assessment and now they're assessing, now they're collecting for the roof. All the stuff is new, right? And that's the lowest case scenario, right? So now maybe they don't need 10%, maybe they're less. Like, so what's going to happen if there's that other side of it, if it's lower?
Absent the professionals who sign that CERS report with their license saying this condominium is fully funded in their bank account, right, for the next 10 years, the Fannie Mae, Freddie Mac, and all lenders are going to acquire the 15% that year.
And that distinguishing factor, like you said, fully funded in their bank account. So they have it already. The requirement from the law, the legislation that came about now is that they are budgeting for it so that when said item needs to come due, it's going to be in their coffer in 20 years from now and 15 years from now. But you're saying, right, the requirement is going to be they have to have that money already in their bank account, regardless of what they're budgeting for. Okay, very interesting. It's going to be fun.
Yeah, so that's going to really affect a lot of condominiums, because a lot of them, like you said, struggle for the 10% right now. And I get it. Nobody wants higher assessments, right? Everybody is concerned about affordability, but we saw what happens with deferred maintenance and pushing that can down the road. It was a tragedy.
Yeah.
So, and it was something that was building up for many, many years. I mean, all of us who knew condos like yourself very intimately knew that this was going to be a problem. So
I knew.
We knew. So, having said that, it is going to be a struggle for a lot of condominiums. Now, to your point, and you raised it subtly, but it's really important, right? Because I know you know condos. So when you take it, it's not just on the budget, what does that reserve number say, but you're allowed to add back certain expenses that the condominium association pays for collectively on behalf of the unit owners that you would have to pay for separately in a single family home.
Water, cable.
Correct. And that always existed today, even at the 10%, right? It'll certainly exist at the 15%. So if it's cable, if it's, sometimes it's, wastewater, sometimes it could be, I don't know, you name it, garbage collection, anything that was separate in a single family home that is paid for collectively through that budget, you can count towards that reserve calculation, right? So that'll certainly be the same under the 15%. But having said that, it will be a struggle for a lot of associations. It will be. So we're hoping, obviously, that they, many of them adopt that and keep it as a warrantable condominium. And we'll talk about what that means if it's not a warrantable condominium at the end of this, okay? There are other loan choices.
Right.
Second thing, this one is really going to be a killer. You mentioned properly that in the state of Florida, a lot of real estate agents thought it was 20% down for what we call a limited review. What does that mean? A full review is think of it as like 10 pages, right? Yep. And a limited review is like 1 page, right? So we don't really care about the budgets. All we want is fill out one sheet, tell us if there's any lawsuits, any special assessment, let me look at your insurance. And it was a fast pass, so to speak, right?
The limited review also changed after Surfside down here too, right? So the limited review ended up having like a little bit of like a rider. They added some questions, right? So even, they did add an addendum, right? So that was added later too to account for a little more things, but it was always much less. So go ahead. Yeah.
And the addendum, you're exactly right. It was all about structure. It was about special assessments and insurance coverage, right? It wasn't enough just to get the evidence of insurance. We actually added extra questions on top of that, right?
Right.
But so I would tell you that, and I do a lot of condominiums, 75% of the condominiums opted for limited review because 50% of the condominiums in Florida couldn't pass a full review. So most people went with the limited review, which meant if it was a primary home, you had to put 25% down on the state of Florida. Okay, if it was a second home or investment, you had to put 30% down in the state of Florida. Well, guess what? That's going away this year.
Bye-bye.
The limited review will no longer be available to anybody in the country, including Florida. That is the August one. That's August 3rd, 2026. That is around the corner.
So if you are out there right now, guys, we are in May. If you are out there right now shopping for a condo and you have not locked anything down yet, and you are putting 25% down, I'm going to preface this by saying, forget about what Fannie, Freddie require. I think it's important, regardless if you're buying a condo, to be knowledgeable and make sure you know that all these things are in place, right? These are guidelines. If you ask me 10%, 15%, it was always arbitrary because it was never even enough anyway, right? Clearly. But you have to be educated on the condo. Make sure that you know everything and you're getting all the information. So if they're approving it and they have their guidelines, like I'm saying this because somebody might say, oh, well, they should always do that so that we can make sure that we're making the right decision. And so if the bank is not going to approve it, why should I buy it, right? So right at this point in time, if you're doing a limited review and you are, the condo is stacking up for a limited review right now, you should still have seen the minutes. You should still look at the surge. You should still look at all those things to make sure. You should look at the insurance. You should look at those things, because even though you're putting 25% down and the lender's not looking for it, make sure that you're making that right decision. But now moving forward, if you're not locking that place down, if that condo doesn't pass a full review, and a lot of lenders are probably going to start rolling that out like any day now, right? They usually will start kind of putting things in place earlier. You're going to be in a position where there is no such thing. So you might be putting 25%. There is no more limited review. Now, if you're putting 25%, the condo has to pass a full review, period. So that's going to be, that's going to be interesting.
Yeah, that's going to be a tough one. And we're already down, the numbers better than I do, but I heard numbers of like 25% decrease in condo sales from last year.
Yeah.
I can only imagine what this is going to do. And again, there's alternatives, and we'll talk about them at the end, but they're usually more expensive alternatives in terms of rate. Let's circle back to insurance again. One minor but technical thing is the per unit deductible on a master policy. So in other words, ways to associations and their boards are always trying to reduce that cost, and I understand that they should. It's their fiduciary responsibility. One of the things that you could play with are deductibles. The per unit deductible is now stuck at a cap of $50,000 per unit. So in other words, what that means is any claim or damage you're using under the master policy for one particular unit, you cannot have that deductible be more than $50,000 per unit. So for example, let's say it was $100,000 per unit. It's almost like you and your home. The higher your deductible, the cheaper the insurance.
Right.
Well, that was another area that some of the associations were playing with. They were raising the per unit deductible. So that they stopped that now at $50,000. Okay. Let's circle back to one of the good things that I passed by. This is good. Although it comes with a footnote. Investor concentration used to be capped at 50%.
Yes.
Right. They totally struck that out. They wiped that out of the guidelines, okay? However, so in other words, there is no automatic fail if you have more than 50% of your units owned by investors. Now, that was never a fail if you were buying a primary home, by the way. I don't know if people knew that,
yes,
right?
I do know that, yeah.
Right. Now, it's not an automatic fail, whether you're buying it as a primary, secondary, or investment property, which is great news. However, it comes with a caveat. It is up to the lender's underwriter's discretion whether or not it becomes a non-warrantable or doesn't pass Fannie Mae based on investor concentration if other things are present that produce other risk. For example, if they're not meeting any of the other guidelines within the full review, or if they're barely meeting them, the underwriters at the lenders have the right to say, guess what? 80% investor concentration, and there's some other concerns we have in this full review, and we feel overall that this risk assessment is too high for acceptance. They still maintain the right to reject it based on investor concentration, but it's not an automatic fail. My professional feeling on this, and having been with a lot of condo directors and underwriters, if it passes everything else, because for me, you either pass or you don't. I don't care if you pass like me. You pass at an 80% on an exam, you pass whether you got 100% or 80%, right? So if you pass all the others, I believe that most lenders will still accept the investor concentration at whatever it is, right? That's going to be a hard one subjectively to make determination if it passes all the other full review parameters, okay? So that was nice to take away because that was certainly an issue down here. Just going through my notes, so I make sure I don't miss anything. One of the things I do want to comment on, and you and I've talked about this in the past, you can't dabble in condos as an agent, right? If you're an agent.
I was going to ask you a question. That was actually another question I was going to ask you. I'll take it.
I've been dealing with agents my whole entire real estate life, mostly in South Florida, mostly in Broward and Palm Beach County. And there are a lot of agents out there, God bless them, and I get it because everybody has to make a living, but you can really do a disservice to your client extremely if you do not know condominium.
Condos are a different beast, guys. Condos are a different beast. I can tell you that. I mean, I have a class on it that I teach that I created years ago, 6-7 years ago. Basically everything you need to know about condos, and it's obviously evolved because it's always been evolving. I made it 7-8 years ago, right? But there's so much out there that. And it drives me insane when I speak to agents that don't understand what condo financing is. And so the question I was actually going to ask you, this show that we're doing right now is really going to be about the changes of the condos, and that's kind of how it evolved as we're going through it. Because otherwise we could talk for like 4 hours. But I'm putting it out there now that you're saying about agents and you can't dabble in it. Like, what would you recommend? And I'm going to share, maybe you can qualify this. If you're selling a condo right now, everyone out there, I think it would have merit to spend the $200-$300 or whatever your association charges in the beginning. Get the full condo review done. And then get it with a lender that's good, that knows their stuff, someone like you. And it may not be, obviously you can't have a buyer use that lender, right? They could choose whoever they want. But I've been starting to do that and suggest that because why would you want to get to that? Because there's so many questions, right? Like, you can get the insurance, you can get the budget, but there's so many more things that, like, I used to be like, all right, A, B, C, and D. Like, if we can get this out of the way, we're like 95% in the clear. But now it's like, I got all this in the way, and I got 18 other things that come up. You can slap with this and slap with that. So I think, and you can correct me if I'm wrong, like, how can we get ahead of this? Because, you, as a realtor, I can market that property and be like, hey, Joe Schmo with XYZ Loans has done a full condo review on the project, right? And it's been cleared so that buyers looking and they know. Otherwise, you're going down that rabbit hole. Like, what are you doing? You're literally doing the inspection. You're doing the appraisal. You're ordering the condo questionnaire. You're paying for the approval for the association. You're doing all of that, guys, in the first week. You just drop like anywhere from $1,000 to $2,000, depending on where you're at, right? And you're throwing that out there. And now you're going to this condo and you're like, oh yeah, I want to buy this condo, right? Like, and you don't know, because a lot of these things you don't get from these buildings. I can't even get them as the listing agent. I'm chasing things down. My sellers can't even get them half the time. But when you get the lender, they're going to get it, fill it in their portal. They submit it. So I'm honestly going to be doing that moving forward and telling the seller, like, this is going to make you marketable, right? Like, just like you're cleaning your house and spending money to clean it. Like, we need to get ahead of this, because yes, they may not use David's and he may have done the pre-approval. And maybe they will. They can have the option if they want to talk to him, because now they don't have to pay for the condo questionnaire and we've already done all the legwork and we can get through this quicker, right? So, like, what are your thoughts on that? Because that's something that I've just been playing with, because I'm like, I'm very efficient, and it's not going to be good to just go through these processes and then have these buildings fail.
So I've been doing, in the last probably 2 years, at least 2 condo reviews a week for my agent partners as listing agents. So it's funny because, I'll go and I'll talk to agents and they'll say, well, I've got my buyer's lender and things like that. And I'm like, that's okay, that's great. However, have you ever had, and they'll say, oh, I only do listings, you have no value to me. And I say, well, wait a minute. I do 2 to 3 condo reviews a week for listing agents, partners of mine, and I'm happy to do it because I know it, and they're doing the smart thing, and now they're able to put on the MLS whether or not they can get conventional financing. I have access to Fannie Mae's condo project manager directly, right, and I have the experience and knowledge. Now, here's the good news, and we touched upon this a little bit, but I'm going to expand on it. So one of the good things that the law has in it is, as of today, any condominium that has either 150 or more units, they have to have a website portal
Yes.
that every homeowner that lives there has an access to. They may not know it, right? You
Yep.
may go to your seller and like, maybe they're elderly, maybe
Not
they're not
tech
good with
savvy.
technology.
Yeah.
But they can get access to it by requesting a reset of their username and password and saying, hey, Nicole, here's my username and password.
I do it all the time. I do that all day long.
Bylaws, they have the declaration of condominium, they have the minutes, they have the cert, they have the milestone inspection. They have all of that now based off this new law starting in 2019. If it was 150 units or more, anything and everything a lender could ever need is right there.
Yep.
Okay, including the insurance. The challenge is, as you know better than I do, is getting that seller to spend the 10 minutes listening to you and saying, hey, look, you need to get me access to this portal so I can send it to my lender. We get this reviewed up front. It's worth its weight in gold.
No, 100%. Yeah.
Yeah. So anything between 25 and 149 units has to be done, or it looks like January 1st, 2026 was that date. So that means that pretty much any condominium from 25 units on, as of today, by law, must have a homeowner portal with all of this information in it. So going back to what you said, I am happy to review condominiums, pre-listing. I can look through all the documents.
And that could be a value add that we offer to our clients too. Saying, all right, listen, we'll order it, right? And then you can order it, and this listing agent can help pay for it. And then it depends how you want to do it if the seller wants to. But I think that has to happen. Like I said, I was starting to do that. And when we go under contract for the listing, I always will ask for those portals if they have one. I'll help them reset it. I'll help them create it sometimes because I work mostly in the senior space. And then I get that information. I download everything. I put things on the MLS. I have a Dropbox file. We share that, and I'll send things to the lender to kind of like pick at it and look and just make sure. But the official, condo approval process, the questionnaire, I think is going to be really important moving forward. If not already has been important, because otherwise everyone's just wasting their time and money and hearts, right? Like why bother? Yeah.
Can you imagine taking a listing and not knowing any of this or asking any of this? It's literally like going in with a blindfold.
Yeah. And you're just like taking the buyer, and then the buyer's like all whoop-de-doo excited, and then he finds out you can't get the property. Like we have to do those things. I think, there's so much that we can really go down the road with this, but thank you for all of these updates. That's going to be a huge change for us.
And there is one thing. So let's say worst case scenario, you can't get a conventional Fannie Mae, Freddie Mac loan. There is the world, and I'm sure people have heard it before, called non-QM or non-qualified lending. Not to get technical, if it doesn't pass Fannie or Freddie, there are alternative loans that will take on that quote higher risk, if you will.
Right.
Depending upon what features it fails at, you have different lenders that are okay with it, right? Some will do one or two, some will do multiple, some will do all.
Right.
But know that it comes at a cost, obviously, higher risk, higher rate. But they are available, and I do them all the time as well.
Yeah, no, and I think we'll definitely pick up on another show as well on some other more digging into all of this, because like I thought originally it was going to be a lot anyway. But I really appreciate your time and knowledge and helping kind of put some things out there that it's right around the corner, obviously. So I do, and a lot of things that I'm thinking about now is it's all popping in my head. But we'll carry on in another show too. David, let everyone out there know how they can contact you if they have any questions, where to find you, and the best way to do that.
So you can find me at my cell phone direct. You can always call or text me as 954-448-6153. My email is DSHEIR, first initial, last name, no spaces, nothing like that, at C, M as in Mary, F as in Frank, CMGFI.com. So D Sheir at CMGFI.com. Also, I do have a realtor cheat sheet, if you will. If you want a copy of it, I can email it to you. Just reach out to me, and
awesome.
It'll have these things on there as well. Okay.
Awesome. Well, thank you so much for your time, and I really appreciate it. Everyone out there, thank you so much for listening in today. This was really just basically the condo financing and major changes that we're going to see happening. I'm going to put another show together that kind of digs into a little bit more of it, because it's just so much, honestly. But if you have any questions, don't hesitate to reach out to me or David if you want to discuss anything further, financing, any kind of financing. Obviously, he does as well. And if you have gained any knowledge or tidbits out of this, please like, share. The purpose is to make sure that everyone's being kept well informed and making the right decisions for yourself as a byproduct of that. Thank you guys so much for being on with us today, and I look forward to seeing you on the next one. Have a wonderful day.
Spreadsheets, clunky software, 100 different logins just to run your business?
There's a better way. Odoo. One simple, connected platform that handles sales, inventory, accounting, and more, so you can focus on growing, not juggling. Make the switch today at odoo.com. That's ODOO.com.